Depreciation is a tax deduction for property investors. We invest in property to increase our wealth over time. One thing that we need to do is make sure we claim all the things we can claim, one of those being depreciation. Items in the property are wearing out over time. The building's one day going to fall over, I guess, and so the tax office allows us to claim part of the cost of these things and the value of these things in properties as a tax deduction each year. As one of the first questions, Bryce, we work alongside the accountant is the answer to that. The accountant does all of your tax return. We pull together basically one number for the tax return, which is the depreciation number. Now there's two reasons we work alongside them. We're a specialist in getting as much deduction as we can because we know all the rules. But secondly, there's something around compliance where we traditionally quantity surveyors estimate construction costs of buildings. So the tax office says we want someone who knows about the construction costs of buildings involved in this process, so we'll accept the estimates done by a quantity surveyor or a relevant professional such as a quantity surveyor for the purpose of the depreciation on the building. Yeah, there's sort of two areas of depreciation, and the first relates to what we call plant and equipment, or the tax office calls it plant and equipment, fixtures and fittings. There's no special dates on those things, but they're like carpets and hot water services and blinds and stoves and things like that. But the other part is a deduction that relates to the structure of the building, and you get to claim 2.5% of the construction cost each year. And in order to do that, a residential property now basically needs to be built after 1987. So if it's built before then, you don't actually get something on that original structure.